Hello, everybody. We are Crowdfunding Finder, and we'll discuss the most important topics for you to consider before investing. I'm the head of marketing initiatives at Crowdfunding Finder, and my goal is to help people get familiar with this new opportunity for investing and supporting small business and startups. To begin, I'm gonna introduce our founder and CEO, Itai Galan, and we'll talk a little bit about the company and how it came to be.
I'm excited to start off this session and educate people about equity crowdfunding and startup investments. We have a groundbreaking opportunity to disrupt startup investments. For the first time, everyone is allowed to invest in early stage and growing businesses. The U.S. Securities and Exchange Commission, the SEC, has regulations that can allow for that. Everything changed in 2016 when the SEC finally removed those restrictions with Title III of the Jobs Act. So I just wanted to share this opportunity with everyone and democratize startup investments. My thought process was the sharing economy enables us to, share apartments like Airbnb and share rides like Uber. Why can't we share ideas and share resources to start businesses or invest in them? I came up with that, and I thought, there should be a marketplace to help retail investors, and will make it easy for them to navigate the still nascent and confusing landscape.
How does the platform actually work? What is the value that it can offer to the users?
Our website aggregates companies' investments offers from different crowdfunding platforms. With Crowdfunding Finder, you have a great option to view companies grouped by industry. And so for no charge, you can reduce your effort when looking for your next investment while getting access to many educational resources and news about the crowdfunding industry and new deals that are available in multiple platforms.
So now we would like to share with you our company video that explains a little bit of the industry and how we aggregate the offerings.
With the new crowdfunding rules and technological improvements, individuals are becoming online investors in new and exciting enterprises. But to access a broad range of potential investments, users must join numerous platforms, all of which have their individualized style and set of standards, resulting in difficulties in filtering, analyzing, and comparing the information and investments presented. Gold Eagle provides a solution. Gold Eagle allows users to develop a network with their peers, where research, due diligence, and ideas are shared. Gold Eagle facilitates the investment process by enabling users to learn more about investment opportunities in a user-friendly manner, and to collaborate with other users, resulting in more informed investment decisions.
What is crowdfunding?
Crowdfunding is the alternative method for entrepreneurs, for creative thinkers, and nonprofits to get funding. It's pulling together of small amounts of money from a group of people that share a passion and interact with online using social media. Everyone can use it without going to banks or VCs, and the likelihood of getting funded is significantly higher than in conventional fundraising. So new businesses find it, difficult to raise funds because they don't have sufficient income, they don't have cash flow or collateral, while they experience high R&D and scaling costs. The important thing is to know that there are 4 crowdfunding options available to companies.
What are these 4 types of crowdfunding that you mentioned?
The 4 main options are donation, reward, lending, and equity crowdfunding. When researching for crowdfunding, it's very common to see the term backers. So backers are essentially the people who support the company's idea and donate to the campaign.
What is donation crowdfunding?
Donation crowdfunding is a way to source money for a specific project by asking a large number of contributors to individually donate a small amount to it. Examples can be, local organizations set up for disaster relief. They can be emergency fundraising.
And for the reward one, can the backer expect any money back?
No. So even though this method offers a reward, it's generally considered a subset of donation-based crowdfunding since there's no financial or equity return. It's popular with small business, with the entertainment sector and with project-based raises. The premise here is that pledging money into a fund in return, instead of earning a financial return, you'll get a gift or benefit or experience that is aligned with the company's proposition. Supporting an original idea is enough to provide the contribution.
The crowdfunding lending, what is that, and where can the investors find this kind of investment opportunity?
It comes in many forms. It has debt-based, it has peer-to-peer lending, and crowdfunding lending. It basically matches people who want to borrow money with people who want to lend, but with substantially better rates than traditional saving accounts. P2P or peer-to-peer has only existed since 2005, and it's practically lending money to personal borrowers to set up a business or any other purpose. The lender gets its principal money back plus some interest rate after a set period of time. And the main platforms that offer lending options are Peerform, Lending Club, Upstart, Prosper, and Funding Circle.
And now, last but not least, the apple of the investor's eyes, equity crowdfunding. Can you explain to us how does it work?
So equity crowdfunding is for people looking to invest in a business like a startup or real estate, etc. Equity crowdfunding, you're doing it for return. So in financial terms, when you put money and expect a return, it's called a security. Ownership is what comes to mind when most people, think about investment. It's important to know that this is the most volatile, but also a very profitable class of investment. Crowdfunding involves multiple investors where each investor gets a small share of the assets. So sometimes as small as $100 or less. The low minimum investment criterion makes crowdfunding investing accessible to a large number of individual investors.
Who is this investment good for? How can we find these available opportunities?
The investment is good for everyone with disposable income and a risk appetite to invest for the long run. But with the new equity crowdfunding regulations, the general public can also contribute to the investment offering as long as the offering is listed on an equity crowdfunding platform that is registered with the Securities and Exchange Commission. So there are, different types of registration that govern how many investors can be on an offering. The maximum amount of investment and who can invest, which is generally determined by income and wealth levels. And these regulations are under several regulations. There are regulations CF, Title III, there's Reg A, there's Reg D, mini IPO. The crowdfunding platform that posts the company offering is registered under a specific rule, which determines the characteristics of the offering. So it would determine, how much money you can invest, how many investors can be on an offering, what is the maximum amount an offering can have, things like that. This is where we add value to the industry. We aggregate the offering from all the platforms that I mentioned, the Republic, Start Engine, WeFunder, etc., into an easy to use and compared marketplace. And we create a community around this marketplace where you can network with, members, you can share reviews, you can rate companies and share the ratings on the companies, you can start blogs and chat rooms, and you can feel empowered to make solid and educated investment decisions.
We will transition now to the regulation part. And to do so, it's important that you understand some concepts that define the industry. Can you please guide us on the evolution of the securities law?
Yeah, absolutely. So it started in 1929. Everybody knows about the stock market crash that caused a great economic depression in the U.S. capital markets. So in an effort to protect the general public, financial well-being, Congress enacted the 1933 Securities Act, which served two purposes. The first was to allow investors access to financial information on the securities they invested in, and the second was to prohibit misrepresentation, fraud, and deceit in security sales. The Security Act requires that all offers and sales of securities be registered with the SEC, except for some exemptions that were defined. Most commonly utilized exemption from Securities Act registration is private offering exemption. It's called Rule 506 or Regulation D. And under this law, private investing was only accessible to wealthy investors. So to qualify for this exemption, the company offering the securities can raise an unlimited amount of money only from these accredited investors. But it is not allowed to use general solicitation or advertising to the public to market the securities. An accredited investor is a person or a business entity. It's important to know that it sounds like it's a person investor, but it could be an entity that's allowed to deal in securities that may not be registered with financial authorities. Accredited investors include natural high net worth individuals, but also, banks, insurance companies, brokers, and trusts. Since the capital raising exercise involves a complex and costly process, including regulatory filing, many companies offer securities to, accredited investors directly. And under Reg D, companies are exempted from registering securities with the SEC, which cuts costs. However, they're only allowed to sell the shares to qualified accredited investors.
And what are the requirements to be an accredited investor?
To be an accredited investor, a person needs to have an annual income exceeding $200,000 or $300,000 jointly with a spouse. A person is also considered accredited investor if they have a net worth exceeding $1 million, either individually or with a spouse. For an entity to be an accredited investor, it needs to be a private business development company. It's called a BDC, or an organization with assets exceeding $5 million. Individuals or parties who want to apply for accredited investor status can approach the issuer of the unregistered securities, who may ask the applicant to respond to a questionnaire to determine if the applicant qualifies as an accredited investor. In 2012, President Obama signed the JOBS Act, which stands for Jumpstart Our Business Startup Act. And with that, they had multiple financial innovation that became legal. The legislation has, 7 sections that became completely official in 2016 when the SEC finalized all the appropriate regulations. So for some, it lowered reporting and disclosure requirements for companies with less than $1 billion in revenue, and it also allows advertising of securities offerings. It also allows greater access to crowdfunding and greatly expands the number of companies that can offer stock without going through an SEC registration. The JOBS Act also allows retail investors to invest in startups in 2 ways. So first, it lets startups raise up to $1,070,000 via crowdfunding platform online, which, as we said, is a form of investing by many small investors pooling their resources, and they're not necessarily all accredited. And this is different than, crowdfunding websites such as Kickstarter, where people only donate money and don't expect to receive an equity for their contribution. And secondly, it greatly expands the category under a rule called Regulation A, which allows companies to offer up to $50 million in stock each year without going through the process of registering with the SEC.
Okay, so can you summarize for us why is this JOBS Act important?
In summary, the JOBS Act help entrepreneurs get new innovative businesses out of the ground quickly. Since the majority of new jobs in the U.S. come from small businesses, this could be, a significant driver for job growth. And individual investors now have access to one of the most profitable asset class in history.
What should investors analyze before investing in a company?
Nothing good comes without a little risk or with something bad, associated. So that's true. So first, you have to have in mind what type of companies these are, right? So many of these companies are investment crowdfunding websites because they couldn't attract other forms of funding, right? They couldn't attract money from venture capitalists or through small business loans. Second, you have to check if you meet the requirements, right? So even though you don't necessarily, and it depends on the rule, on the regulation, but you don't necessarily need to be an accredited investor, the SEC still aims to protect the small investor and determines the amount that people can invest in crowdfunding in order to reduce the risk. At Crowdfunding Finder, we always advise our members to only invest money that you can afford to lose. Third, there's a risk of loss of value. Unlike listed companies, public companies, that are valued through the market-driven stock prices, the valuation of these private companies, especially startups, is very difficult, right? So you risk overpaying for the equity stake that you receive. Also, those investments in startups and early stage ventures are speculative, and these enterprises often fail. The success of a startup often relies on, development of a new product or service that may or may not find a market. Also, there's, lack of information that also possess another risk. For the crowdfunding campaign, the company must disclose information about itself, its business plan, the offering, and its anticipated use of proceeds, among other things. However, as a private company, it's not legally required to publicly disclose, financial statements. An early stage company may also be able to provide only limited information because it doesn't have fully developed operations or a long history to, provide more disclosure on revenue and income, for example. And lastly, you have to consider that if you can handle illiquidity, because, you can't just pool your money whenever you want. You have to wait until the company starts making payments when it either, starts generating profits in the case of a debt crowdfunding, or, with equity crowdfunding, you have to wait for an event of liquidity, which is normally either an exit that somebody bought the company or an IPO when the company first went public.